Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. The stock market has continued its historic rally with the S&P 500 gaining 19% year-to-date with reinvested dividends, contributing to a total return of 61% since the market bottom in 2022. While much of this performance has been driven by large-cap technology stocks over the past 18 months, there are now signs that other parts of the market are benefiting as well. What should investors know about diversifying across sectors and styles over the next several quarters? Performance is broadening beyond large-cap growth. While investors tend to focus on major market indices and the one or two areas driving recent returns, the reality is that performance leadership tends to change over time. Large-cap tech stocks have dominated headlines recently, and for good reason. The Magnificent Seven stocks have gained 192% over the past year and a half. As the accompanying chart shows, there are now signs that other areas of the market are beginning to participate, with three important implications for investors. First, recent economic reports confirm that inflation is improving, which could lead the Fed to cut rates once or twice this year. Growth and value can each outperform over long periods. Value stocks have performed better recently due to these same factors. Notably, this has not been at the expense of growth stocks per se. Instead, value stocks may be in the early stages of catching up after lagging for the past 18 months. The accompanying chart provides historical perspective on how value and growth have fluctuated over time. In the late 1990s and early 2000s, growth stocks outperformed during the dot-com boom. This then gave way to strong outperformance of value stocks through much of the 2000s. This cyclical rotation from growth to value and back has occurred throughout history, driving much of the academic research around the value premium. So, while growth stocks have strongly outperformed most recently, history shows that leadership changes are not unusual. Diversifying across styles helps to reduce portfolio risk. Finally, the outperformance of growth stocks does not mean that diversification is no longer relevant. In fact, the opposite is true. Diversifying across styles allows investors to benefit from recent market trends while also protecting their portfolios from potential risks. The accompanying chart shows that those parts of the market that have performed well also have excessive valuations. The price-to-earnings ratio of large-cap growth is now 28.4, driving the overall S&P 500 index PE to 21.2. In contrast, large-cap value only has a PE of 15.7, while small-cap value is far less expensive at 13.8. This is the case even though small-cap value stocks are expected to experience earnings growth rates similar to large-cap growth stocks over the next 12 months. Performance has broadened across sectors as well. 10 of the 11 S&P 500 sectors have positive returns this year, with only the real estate sector slightly negative. Many sectors have year-to-date gains of 8% or more, including financials, utilities, consumer discretionary, industrials, consumer staples, healthcare, and energy. The bottom line? History shows that long-term investing isn't just about predicting winners. It's also about diversifying across styles, sectors, and more. Market leadership not only changes over time, but also can do so swiftly. Staying diversified allows long-term investors to benefit from opportunities while also having a smoother ride as they work toward their financial goals. Thank you for listening. For additional information, please visit mraadvisory.com.